Hello everybody, this is Lara with your end of the week video for US oil for the trading week ending 14th of February 2020. Both my wave counts were expecting upward movement this week, and that's again exactly what we've got. The low remains in place. It was tested but not breached, and that's pretty typical for the beginning of a new trend, especially for this market. The target for the main bearish wave count for this upward swing is 65.83. Elliott Wave Analysis first, Classic Analysis last. Classic Analysis offers more support to this main Elliott Wave count than the alternate. My main count is bearish, my alternate count is bullish. Let's go through each one in turn. A simple Elliott Wave structure is 5 steps forward, 3 steps back, and this wave count expects that 5 steps forward ended up here and 3 steps back is incomplete, and it's labelled Supercycle Wave 2. Second waves are most commonly zigzags or multiple zigzags, and this structure is a double zigzag. Here's the first zigzag in the double. It's labelled Cycle Wave W. It was over down here. The double is joined by a 3 in the opposite direction, labelled X, which also subdivides as a zigzag, and that's the most common structure for X waves by quite a wide margin. The second structure in the double is a zigzag labelled Cycle Wave Y, which should subdivide at primary degree A, B, C, subdividing 5, 3, 5. And wave B within a zigzag may not move beyond the start of A, hence the upper invalidation point. The purpose of a second zigzag in a double is to deepen the correction when the first zigzag may not have moved price deep enough. To achieve that purpose, cycle Y would be expected to end reasonably below this point, the end of cycle W, so that the whole structure has a clear downward slope and looks like a normal double zigzag. Let's take a look at the weekly chart. We're going to look from this high here, cycle X, this point here. Now we're focusing on the structure of cycle Y, a zigzag 5, 3, 5. The structure of primary B still looks incomplete. I'm labelling it here as a double combination, and that's a reasonably common structure, particularly in a B wave position. The first structure in the double may be complete here. It is labelled Intermediate Wave W. It subdivides as a zigzag 5, 3, 5. The double is joined by a 3 in the opposite direction labelled X, which also subdivides as a zigzag, and that's the most common structure again for X waves within both double zigzags and double combinations. And the second structure in this double combination begins here, and it's unfolding as a flat correction labelled Intermediate Wave Y. Flat corrections subdivide 3, 3, 5, and they may have wave B move beyond the start of A, and in fact that's fairly common because the most common type of flat is an expanded flat. Wave B within an expanded flat is 1.05 or longer the length of wave A. Wave C of a flat would be extremely likely to move at least slightly above this high back here, so that it avoids a truncation and a very rare running flat. It does not need to move beyond this or this swing high, only this one, to avoid a truncation. The term truncation refers to where C ends in relation to its counterpart wave A of the same degree. And so intermediate Y is expected to be an expanded flat 3, 3, 5. Within it, minor wave B was an expanded flat, subdividing 3, 3, 5. This is a typical looking expanded flat. It moves price sideways in an ever increasing range. And so I'm expecting upward movement for minor wave C. Let's take a look at this at the daily chart level where minor B ends down here, which is this point down here. Now we're looking at all of intermediate wave Y as a flat correction, subdividing 3, 3, 5. Minor wave B also a flat correction, subdividing 3, 3, 5, and within it, minute wave B, also a flat correction, subdividing 3, 3, 5. That's pretty common actually to see flats nested within flats in B wave positions. So this follows a pretty common Elliott wave pattern, not just for this market, for many markets. Minor wave C is expected to subdivide as a 5-wave structure, and so it may only be an impulse, which is much more likely, or an ending diagonal. I will expect and chart an impulse until and unless overlapping suggests a diagonal. So far within minor wave C, minute wave 1 and 2 could be complete. If minute 2 continues any further, it may not move beyond the start of 1, below the short-term invalidation point. I'll still use this confidence point, but the size of this sideways and upward movement for this week now doesn't look like part of this downward movement. This looks like the start of a new movement. However, a new high above this point, 54.38, could not be a second wave correction within minuet wave 5, and so at that point, a new high above this swing high would indicate that minuet 5 should be over, which would mean minute C, and so minor wave B should be over. And that would add confidence that we have a reasonably, or at least for the short to mid-term, sustainable low back down here. The target for minor wave C is for it to reach 1.618, the length of minor wave A. That's a common Fibonacci ratio for wave C within an expanded flat. And intermediate wave Y is indicated as an expanded flat because minor wave B was longer than 1.05 the length of A. It was 1.13 times the length of A. At the monthly chart level, if we move the degree of labelling of this big zigzag up 1 degree, it is of course possible to see the bear market for oil could have been over, and this could have been a sustainable low right at the end of December 2015. However, this wave count does not have as much support from classic technical analysis, and there is one very big problem in terms of Elliott wave at lower time frames that reduces the probability of this wave count. Elliott wave, like all technical analysis, is dealing with probabilities, not certainties, and it is important always to use alternate wave counts and consider all possibilities. The best idea is to chart as many alternate wave counts as you can see and then rank them in order of probability. If the most likely wave count turns out to be invalid by price action, then you move to the next most likely wave count, and so on. In that way, you would have a roadmap for expected next direction, which is basically the purpose of Elliott wave, to try and tell what is the most likely direction of price next, and so make a profit, because that's what we're all here for. And so let's consider this less likely possibility. If this bear market is the end of the bear market for oil down here, and this is the start of a new bull market, which we really can't tell until we get new swing highs above back up here or even here, and then we would get price confirmation. But until then, this is a possible roadmap for a future bull market for oil. A second wave at supercycle degree may have been over here, and a third wave at supercycle degree may have begun. If that's the case, then in terms of Elliott wave, the first movement up off that low must subdivide as a 5-wave structure. That's okay, it will fit in my experience and opinion. This fits better as a 3 than a 5, which is how my main wave count sees it, but it will also fit as a 5, and so we should consider all possibilities. This downward movement does look better at lower time frames as a 3, and so because it's 0.618 the length, very close to, this upward movement I am labelling cycle wave 2 over here is a quick, sharp zigzag. And cycle wave 3 within supercycle 3 may have begun here. Within cycle 3, primary 1 within cycle 3, primary 1 and 2 may be complete. This bullish wave count now expects a third wave at 1, 2, 3 very large degrees may have begun very recently down here. This bullish wave count now requires good strong upward movement with push from volume. A third wave at primary, cycle and supercycle degree should be unmistakable. If upward movement continues to lack support from volume and sees declining range, that will further reduce the probability of this wave count. If primary wave 2 were to continue further, it may not move beyond the start of 1 below this invalidation point. The target for cycle 3 is for it to reach a common Fibonacci ratio to the length of cycle wave 1. Let's take a look now at from the end of cycle 1 on the weekly chart. This high here is this high here. Here's cycle 2, which looks quite nice as a zigzag, although this downward movement will also subdivide very well as a 5-wave structure. And that there is one of the difficulties of Elliott Wave, which is no different to any other technical analysis method. They all have their drawbacks and difficulties. It is not always possible to tell with absolute certainty whether a movement subdivided as a 3 or a 5, because it depends on what degree you label all of the little corrections within that movement. And so when it is not possible, then you have to consider both possibilities. Is it a 3 or is it a 5? Whereas sometimes, going back to the monthly chart, it is possible with quite a lot of confidence to tell if a move was a 3 or a 5. This move from this high to this low is very obviously a 3. Trying to count this as a 5 would be quite ridiculous. And so it's not always possible to tell which it is, and when it's not, you have to consider both possibilities. If cycle 2 is over here, cycle 3 may have begun. This upward movement would need to subdivide as a 5-wave structure, and this is the biggest problem in terms of Elliott Wave with this wave count. When we look at this movement on lower time frames, it's very difficult to see the middle of the 3rd wave complete. There is a great problem in terms of proportion. The little 4th wave coming at the end, counterpart to this, needs to be seen almost at the hourly chart time frame to be viewed. That disproportion is too great at higher time frames for this wave count to have what we call the right look. I will consider all possibilities, but that is quite a problem for this wave count and reduces its probability. If this is a 5 and we're considering all possibilities, then a 2 in the opposite direction may be complete down here. Primary 2 is labelled a double combination, zigzag, X, flat correction. The target for primary 3 is for it to reach a common Fibonacci ratio to primary 1, and this target fits with the higher target for cycle wave 3. At the daily chart level, we're looking now at the middle and end of this combination for primary 2, zigzag, X, flat correction, and expanded flat subdividing 3, 3, 5, where B moves beyond the start of A, both A and B subdivide as 3s, and C moves beyond the end of A, and C is really close to 1.618, the length of A. This looks like a pretty typical expanded flat correction. If primary 2 is over there, then within primary 3, no second wave correction may move beyond the start of its counterpart first wave below the short-term invalidation point. Both my wave counts expect an upward swing up to resistance, or this one an upward swing to then break above resistance. They're both expecting upward movement for a few weeks yet. So there is no difference in the expected direction for the short to mid-term from my bullish and bearish wave counts. And that's okay. Sometimes when you have different wave counts and they converge expecting the same direction, you can have a little bit more confidence that that's most likely what price is going to do, at least for the short or even mid-term. That's what we've got in this instance. Let's take a look now at some classic analysis. At the monthly chart level, I have nothing new to add this week. Last week I was pointing out, and I'll have to point out again for those members who are newer or viewers who are new to this YouTube channel, if this is one video that ends up posted there. Upward movement here had a push from volume, although within it, it's a downward month which has strongest volume. It's this month here. Upward movement ends with a strong bearish engulfing candlestick, which has support from volume in comparison to the 2 months immediately prior, and it had a bearish wick. As price falls, range increases, and price has support from volume pushing it lower. We get to this month and there's a bit of a bullish downward wick, suggesting a bounce. Upward movement comes with overall lighter volume and, importantly, declining range. As price moves lower, range increases. As price moves higher, range declines. There is strength in downward movement, there is weakness in upward. Another very strong bearish engulfing candlestick pattern after a rise of a few months tells us to expect a high in place here and now price has moved sideways. And that's okay because candlestick patterns tell us to expect a trend reversal, but there are three different directions for price, not just two: up, down, or sideways. A candlestick reversal pattern coming after a trend tells us to expect a trend change, in this case from up to either down or sideways, and sideways is what we're getting. Now we've got a huge bearish engulfing pattern and a bearish upper wick with push from volume for January. Downward months continue to be stronger than upward months. I expect that is telling us we are more likely to see a downward breakout than upward after this trading range is broken, and that would support a bearish Elliott wave count, which is one big reason why it is my main wave count. RSI is neutral, room for price to rise or fall. MACD full bore bearish. On balance volume constrained has been making new highs while price hasn't. There is double bearish divergence. I will give more weight to volume range and RSI than I will to divergence with on balance volume though, because of my experience over the years, those are more reliable. At the weekly chart level, we can see this consolidation, support, an upward swing to resistance, downward swings to support, again resistance, support, slightly overshot from here, but there's still support around here, tested and holding. It's reasonable now to expect an upward swing to resistance. In conjunction with support and resistance, using slow stochastics can help us identify where one swing ends and the next swing begins. This is not perfect. Price can overshoot resistance or support before returning to within a consolidation zone, and stochastics can remain extreme for a little while before returning back into neutral. It's a general guideline. Overbought, resistance, support, oversold, choppy, overbought, choppy, resistance, down to support, down to oversold. It's quite reasonable now to expect an upward swing to continue until price reaches resistance, and at the same time stochastics may reach overbought. So let's expect an upward swing. Do not expect it to move Do not expect price to move in a straight line. That's not often how it behaves within a consolidation. This is a good example. Extremely choppy overlapping movement is very typical within consolidations. Elliott wave can help us here. It tells us now that the structure is close to complete, so I am actually expecting a more generally straight trend than something looking like this. I'm expecting something looking more like this for this upward trend, but obviously in the other direction. At this low down here, we've got a bullish engulfing candlestick pattern. While price is at support, on balance volume is at support, and stochastics is oversold. All of that tells us to expect an end to this downward swing here. Volume pushed price lower down here. There's, compared to these previous weeks, some support from volume, but compared to these previous downward weeks, not as much support from volume for the bullish engulfing candlestick pattern here, but there's enough to give it just a little bit of weight. ADX is just below 15, a little too low to indicate a trend. If it reaches 15 next week and the negative DX line is above the positive, it would then indicate at the weekly chart level a downward trend may be in place. We do not have that indication yet. I'm using the guideline of 15 from Kirkpatrick and Dahlquist's classic technical analysis. ATR has been increasing as price was falling, declining as price is rising, showing some increase as price is falling. On balance volume has bounced up off support. This trend line has been tested multiple times, is long held, and is close to horizontal. Those are three things that will increase or decrease the technical significance of a trend line. If it's tested more often, it holds more significance. The longer it's held, it holds more significance. And the closer to horizontal, holds more significance. This one has all three. It has strong technical significance. This is a bullish signal this week from on-balance volume, supporting the view we may have a somewhat sustainable low down here, at least for the short to mid-term. at the daily chart level, while we can see that big consolidation quite nicely at the weekly chart level, when we get down to the daily chart level, each swing looks like a trend. A downward swing here is indicated as a downward trend from ADX. It reached extreme in that it reached above both directional lines, but not very extreme. It's still below 45. Upward movement here lacks support from volume. That's pretty typical within this consolidation. There's a bullish engulfing candlestick at the daily chart level as well, and that has some support from volume, and so that supports the view that there's more likely a sustainable low for the short to mid-term back down here. I've been over ATR at the weekly chart level, so I won't repeat myself for the daily chart level. There's a very short-term support line here. It doesn't have a new range for on-balance volume, but this little bounce up here is a bit of a weak bullish signal. RSI reached oversold for that downward trend, which reached extreme when ADX is extreme and RSI is extreme, and then we see a candlestick reversal pattern. In those circumstances, we give the candlestick reversal pattern more weight. And so that's what I did back down here, and we are getting some upward movement. I'm going to expect that to continue. And that's all from me this week. With your oil analysis, I hope all of our members and viewers are having an absolutely fabulous weekend.